Are you ready to take the plunge into the world of investments? Hello, and welcome to Finstride. You come to the perfect spot if you're new to the stock market. In this video, we'll go over the fundamentals of investing and provide you with 5 vital suggestions to help you get started on your investment path with confidence. Are you interested in learning how to make educated financial decisions? Do you need help navigating the complexity of the stock market landscape? By the end of this video, you'll have a firm grasp of these fundamentals and more. Let's get you started on your way to being a wise investor. The stock market is a dynamic financial environment in which shareholders may purchase and sell their equity to investors. It trades on major stock exchanges such as the New York Stock Exchange and NASDAQ. The digital revolution has altered the scene, with the majority of economic activity moving to internet platforms. The S&P 500 and Dow Jones Industrial Average are 2 notable indexes in this dynamic arena, acting as performance standards for large U.S. firms and offering insights into the health of the economy. To participate in the stock market, investors must first open a brokerage account, which acts as a portal to stock exchanges and trading. To be successful in this field, investors should investigate a company's financials, market trends, and growth prospects, as well as push for diversification to reduce risks. Market volatility is an ongoing concern, stressing the significance of maintaining a long-term view. Emotional moderation is essential since yielding to rapid profits or panicking during downturns can lead to poor decisions. Staying up to date on current happenings in the financial industry and the rest of the globe can give useful context for market movements. Tip number 1. Purchase the appropriate investment. Choosing the correct stock is far easier said than done. Anyone can recognize a stock that has performed well in the past, but forecasting a stock's success in the future is far more challenging. If you want to be successful investing in individual stocks, you must be willing to put in a lot of effort to evaluate a firm and manage the investment. According to Dan Keaty, Chief Financial Planning Strategist at TIAA, when you start looking at statistics, you've got to keep in mind that experts examine the data at every one of those companies with much more rigor than you are capable of as an individual, so it's a very difficult game for the individual to win over time. When studying a firm, you should look at its fundamentals, such as earnings per share or price-earnings ratio, but you'll need to do a lot more. Research the company's management team, assess its competitive advantages, and examine its financials, especially the balance sheet and income statement. These are only the beginning. According to Keaty, buying shares in your favorite product or company is not the best approach to invest. Also, don't place too much stock in past results because they are no guarantee of future success. You'll have to research the firm and predict what's going to happen next, which is a difficult task even in good circumstances. Moving to tip number 2, if you're just starting, stay away from individual stocks. Everyone has heard of a large stock victory or a terrific stock choice. What they forget is that they're often not talking about those specific investments that they also own that did very poorly over time. As a result, people sometimes have unrealistic expectations about the kinds of returns they can make in the stock market, and they frequently mix luck with competence. You can occasionally get lucky when choosing particular stocks. It's difficult to be lucky over time while still avoiding major downturns. Remember that to regularly earn money in particular stocks, you have to understand something that the forward-looking market hasn't already priced into the stock price. Remember that for every seller in the market, there is a buyer who is equally confident that they will benefit. According to Tony Madsen, CFP, founder of Redwood Falls, Minnesota-based New Leaf Financial Guidance, there are a lot of brilliant individuals who do this for a job, and your chances of surpassing them are slim if you're a beginner. An index fund, which can be a mutual fund or an exchange-traded fund, ETF, is an alternative to individual equities. These funds own dozens, if not hundreds of equities, and each fund share you buy owns all of the firms in the index. Mutual funds and ETFs, unlike stocks, may have yearly fees. However, some funds are free. Next, tip number 3, make a diverse portfolio. Index funds are a popular investing technique because they offer a diversified approach to wealth growth. They provide an effective approach to capitalize on the stock market's potential without significant study or hazardous stock selection. Index funds lower the risk associated with individual stock movements while possibly increasing total returns by mimicking the performance of a certain market index, such as the S&P 500. One significant benefit of index funds is their inherent diversity. Investing in an index fund is simply investing in a diverse range of stocks that comprise the index it monitors. This implies that your investment's performance is not primarily determined by the fate of a single company's shares. Even if one of the fund's stocks underperforms, the impact on your entire investment is likely to be reduced by the excellent performance of other stocks in the same fund. Individual stock investing necessitates extensive study, analysis, and in many cases, a thorough grasp of the sector. Index funds are a great option for those who don't have the time, skill, or willingness to engage in such activities. They also serve as a good starting point for new investors, avoiding the prevalent assumption that everyone can anticipate the movements of specific equities. Overall, index funds provide a great foundation for anyone interested in entering the world of investing without the complexity and danger involved with stock choosing. They provide diversity over a broad variety of firms and industries, minimizing the impact of underperforming equities on the total portfolio. Fourth tip, be ready for a downturn. The stock market is volatile, and investors frequently struggle to control investment losses when stock prices fluctuate. Portfolio diversity is an important approach for mitigating panic-induced purchasing and selling, acting as a buffer against the upheaval that might result from the market's erratic character. Diversification guarantees that no single company has a disproportionate impact on overall portfolio performance, and even index funds are not immune to volatility. The lack of primary guarantees in the stock market implies a conservative perspective. Financial experts recommend that investors investigate alternatives such as high-yield certificates of deposit or CDs, which provide a degree of certainty in returns. CDs, which are primarily issued by banks and credit unions, give a fixed interest rate for a certain period, providing some stability in an otherwise volatile market. Market volatility is a challenging notion for both new and experienced investors since it contains the subtle changes that influence stock prices' frenzied dance. Successful investors recognize that overcoming market volatility necessitates a long-term mindset, patience, and an understanding that short-term changes are an inherent part of the investment process. To summarize, the stock market's unpredictability necessitates intelligent tactics for efficiently managing investment losses. Diversification protects against panic-driven decisions by spreading risk across several assets. Recognizing that volatility extends beyond simple directional swings is critical, and effective investors see volatility as both a predictor of uncertainty and a predictor of growth and financial success. Here we go for the fifth and last tip for today. Before investing real money, try a stock market simulator. A stock simulator is a powerful tool developed for inexperienced traders who wish to understand the subtleties of trading without putting their money in danger. It provides a virtual trading account with virtual dollars, helping users navigate the volatile world of stock trading without putting their money at risk. The simulator serves to eliminate the idea that a person can continuously outwit the market and pick the most profitable companies. Financial markets are volatile because they are influenced by diverse causes. When joining the stock market, one must be self-aware. Aspiring traders should examine their motivations for joining the market to see if they correspond with their financial goals, risk tolerance, and overall investing plan. The simulator provides a secure environment in which to test methods, evaluate their efficacy, and make required revisions without suffering financial losses. The stock simulator can serve as a first step in building a solid foundation of knowledge and abilities for people with long-term investment ambitions. However, for long-term and diverse growth, it is prudent to go beyond individual stock trading. Mutual funds and exchange-traded funds, ETFs, are excellent choices for developing a well-balanced and robust investment portfolio. These products give exposure to a diversified range of equities, which reduces the impact of individual stock volatility while increasing the possibility for consistent, long-term growth. Overall, stock simulators provide a safe environment in which to struggle with the market's intricacies, reducing overconfidence and developing a grounded awareness of the obstacles inherent in trading. As the financial environment evolves, taking advantage of the benefits of a stock simulator may be a wise first step toward financial empowerment and sound investing selections. The stock market offers enormous profit potential, but inexperienced investors must avoid frequent mistakes. To prevent this, they must develop a customized investing plan that is in line with their financial objectives, risk tolerance, and time horizon. Consistency is essential because it avoids emotional reactions and hasty judgments. It is critical to educate oneself on investment and market dynamics to make educated decisions and comprehend dangers. Diversification reduces risk by distributing investments across several industries. Finally, in the stock market, patience, research, and a well-crafted plan may bring significant dividends. Navigating the market's unpredictability becomes more doable with a sound plan and devotion to its execution. So start now, you'll win the match. Thank you for joining us. Don't forget to leave your thoughts and questions in the comment box. Also, do like and subscribe to Finstride for more interesting stuff. Happy investing!